All right, let's unpack this. Today, we are diving deep into a topic that, while it might sound a bit dry at first, holds a surprising amount of financial power for many of us. The net investment income tax, or NIIT.
Hmm.
You sent us the 2024 instructions for Form 8960, and let me tell you, this document isn't just about, compliance, it's kind of a treasure map.
Yeah, it really can be.
Our mission for this deep dive is to give you that ultimate shortcut to being well-informed, sparking those aha moments, so you can approach your tax planning not just with confidence, but with strategic insight, especially when it comes to finding those critical tax-saving opportunities.
That's right. The NIT can feel like a complex puzzle piece in your overall tax picture, but it's a non-negotiable component for many individuals, estates, and trusts. Our mission isn't just to walk through Form 8960 line by line, though we will certainly do that with precision. More importantly, we're here to clarify the what and the why, to illuminate the logic behind the rules, and, to pinpoint exactly where a diligent understanding of these instructions can truly make a significant difference to your financial bottom line, particularly through smart tax planning.
Absolutely. So let's kick things off with the big picture. What exactly is the net investment income tax? And perhaps even more critically, who generally finds themselves subject to it?
Great question to start. Form 8960 is the specific tool the IRS uses to calculate this tax, which is imposed under Section 1411A of the Internal Revenue Code. It's vital to understand this isn't your everyday income tax, it's an additional tax.
Ah,
Think of it as a surcharge specifically applied to certain types of investment income.
an additional tax always gets people's attention, and often their concern. So who exactly gets caught in the NIT net? Are we talking about a niche group, or does it apply more broadly than maybe some might realize?
Well, the fundamental rule is this. Individuals, estates, and trusts are required to attach Form 8960 to their return if they're modified adjusted gross income, or MGI, and we'll break down MGI in a moment, is above specific applicable threshold amounts, and they have net investment income.
Both conditions have to be met.
Those conditions, yes. For individuals, these are the critical thresholds for 2024. If you're married filing jointly or a qualifying surviving spouse, that threshold is $250,000.
Oh,
For those married filing separately, it drops to $125,000.
right.
And if you're single or head of household, the threshold stands at $200,000. If your MBI crosses these lines and you have investment income, you're looking at a flat 3.8% tax
Launch.
on the smaller of your net investment income or the amount by which your MBI exceeds that threshold.
That 3.8% rate on top of everything else can really add up.
Yep.
So let's drill down into what the IRS specifically considers net investment income for this tax. What's included, and more importantly, where are those first crucial exclusions that could save you money?
Right. So generally, net investment income broadly includes gross income from interest, dividends, annuities, royalties, and rents. Pretty standard investment stuff.
Yeah, seems straightforward.
But here's where your first significant tax-saving opportunity comes in. These incomes are explicitly excluded if they're derived from the ordinary course of a trade or business that is not considered a passive activity for you, and it's also not a business of trading financial instruments or commodities.
Okay, hold on. Break that down. Ordinary course of a trade or business.
Mm-hmm.
Not passive, not trading. That sounds like a lot of conditions.
It is, and it's a fundamental distinction. It means if you're actively running a business, and maybe that business generates income that looks like interest, or maybe rent,
Mm-hmm.
it might not actually be hit by the NIT if it meets those conditions. It's about active business versus passive investment.
Ah, so if I'm an active participant in a business, and that business generates, say, rental income because I'm renting out a property to a related actively managed business, that income might actually be exempt from NIT.
Potentially, yes. That's exactly the kind of scenario where this exclusion could apply. It's a huge distinction for entrepreneurs and active investors.
Okay, that's a big one. What else falls under this net investment income umbrella? And then what are the truly big exclusions that our listener absolutely needs to know about?
Sure. Beyond those general categories, net investment income also includes gross income from any passive activities you have. We'll define that more clearly soon. And any income from a trade or business specifically focused on trading financial instruments or commodities.
So day traders, that kind of thing.
Exactly. And it also encompasses any net gain from the disposition, the sale of property, unless that property was held in a trade or business that isn't a passive activity and isn't a trading business.
Okay.
And critically, this net investment income figure is always reduced by any properly allocable deductions. This immediately leads us to thinking about how you can actively lower the base on which this tax is calculated.
Reducing the taxable base is always the goal. Now let's talk about the specific exclusions, the things that are not considered net investment income. Because for our listeners, these are the real nuggets of clarity they're looking for, the areas where they might not owe this additional tax.
You've hit on a critical point for tax planning, definitely. The instructions are very clear about what is not included. For example, any income that's already excluded from your gross income under Chapter 1 of the Internal Revenue Code.
Like municipal bond interest.
Exactly. Or income specifically carved out by Section 1411 or its regulations. Some vital examples to commit to memory for your planning include wages.
Okay, W-2 income is out.
Right. Unemployment compensation, Alaska Permanent Fund dividends, alimony, Social Security benefits, tax-exempt interest income, obviously. If it's tax-exempt for regular income, it's out for NIIT and income from certain qualified retirement plan distributions.
And the one that consistently surprises people, and often comes up in our discussions, is income subject to self-employment taxes. Why is that specific exclusion so powerful and important for someone running their own business?
That's a significant one because it directly connects to active business engagement. I mean, if your income is already subject to self-employment tax, the IRS generally views it as active business income, not passive investment income, so therefore it's excluded from NIIT.
Okay.
This prevents a form of double taxation on certain active business earnings, which is incredibly beneficial for sole proprietors, partners, or S-corporation shareholders who are actively involved in their businesses. Understanding these specific exclusions is paramount, not just for accurately calculating your NIIT liability, but more importantly for identifying when your income streams genuinely fall outside the scope of investment for this specific tax, allowing you, to breathe a little easier.
That's a crucial distinction. It truly shifts how you analyze the source of your income for tax purposes. So let's pivot a bit and dive into some of the more nuanced concepts and definitions that are absolutely vital for calculating NIIT accurately. First up, modified adjusted gross income, or NGI. We mentioned it as the bouncer at the NIIT club.
Yeah.
How exactly is it different from your regular AGI?
That analogy of the bouncer is quite fitting. For many people, NGI is simply their AGI from Form 1040 or 1040 SR, but
There's always a button tag.
isn't there just the but is only if they haven't excluded foreign earned income and don't have certain interests in controlled foreign corporations or CFCs or passive foreign investment companies, PFICs.
Okay, so complex international stuff complicates it.
It does. For those with international income or these complex structures, there are key adjustments. You might need to increase your AGI for amounts excluded under Section 911, which is the foreign earned income exclusion.
Right.
There are also specific adjustments for CFCs and PFICs. For instance, you'd increase AGI for excess distributions from Section 1291 PFICs, or potentially decrease it for Section 951, 951A, or 1293A, inclusions for CFCs or qualified electing funds, QEFs, if you haven't made a special election we'll discuss later. You also have to factor in increases or decreases for distributions from estates or trusts, which you'd find on a Schedule K1, Box 14, Code H. These adjustments are critical because if your MGI is below the threshold, you don't even have an NIIT liability to worry about, regardless of your investment income. It's the first hurdle.
So MAGI is truly the gateway. Let's talk about passive activity next, because this feels like the absolute heart of how investment income is categorized for NIT. What defines it, especially when we talk about trade or business activities, and where's the strategic opportunity here?
You're spot on. Passive activity is central. Under Section 469 of the tax code, it generally means any trade or business where you, the taxpayer, don't materially participate.
Meaning you're not actively involved day to day.
Pretty much. Think of it as investing your money without actively managing the day-to-day operations. And here's a crucial point. Any rental activity is typically considered a passive activity, regardless of your participation.
Regardless, wow.
With only a few specific exceptions. Now, the definition of a trade or business for NIT purposes under Section 162 is actually more restrictive than what the passive activity rules often broadly use. This is a subtle but incredibly important distinction.
How so? More restrictive.
Yeah. For income to be excluded from NIT, the activity must rise to the level of a true Section 162 trade or business, meaning you're doing something regularly and continuously for profit, and it must be non-passive under Section 469. It's that double check that unlocks the NIT exclusion.
So it's not enough to be non-passive under a general definition. It has to be a legitimate Section 162 business and non-passive.
Okay.
This is precisely where real estate professionals often discover a powerful tax-saving opportunity, right? Tell us more about that.
Absolutely. This is one of the most significant opportunities for dedicated real estate investors. If you qualify as a real estate professional under Section 469C7 and you materially participate in your rental real estate activity, then your rental income will not be treated as passive,
Which means
which means it's potentially excluded from NIT. This is incredibly beneficial. The instructions even lay out a safe harbor for real estate professionals.
a safe harbor always sounds like good news. What are the exact criteria for that, and what's the benefit?
To qualify for this safe harbor, you must meet one of two conditions. Either you participate in each rental real estate activity for more than 500 hours during the tax year.
500 hours per activity? That's a lot.
It can be. Or you've participated in a rental real estate activity for more than 500 hours in any 5 of the last 10 tax years.
Okay, that's a bit more achievable, maybe.
If you meet either of these, your rental income and any gain or loss from the disposition of related property is treated as derived in the ordinary course of a trade or business and is not included in your net investment income. Imagine the impact on your tax bill if you're a professional landlord or developer. This is a massive tax-saving tip for those truly immersed in real estate. It's also worth noting that if you have a Section 1.469-9G election in effect, all your rental real estate activities can be grouped as a single activity for that 500-hour test, potentially making it easier to meet the hour requirement.
That's a clear pathway to exclusion for truly active real estate investors. Are there other special rules for rental income that could also lead to NIED exclusions?
Yes, there certainly are. For instance, rental income can be recharacterized as non-passive if you rent property for use in your materially participated trade or business, or if that rental activity is properly grouped with such a business under the regulations.
Like renting a building to your own operating company.
Exactly. The benefit here is substantial. This recharacterized income and any disposition gains or losses from that property are then treated as derived in the ordinary course of a trade or business, and crucially, are not included in your NIT. These are important exclusions to be aware of if your rental activities are closely tied to your other active business endeavors, as they can significantly reduce your NIT liability.
That's another powerful way to distinguish active business income from purely passive investment income. What about former passive activities? How are unallowed losses from those treated? It sounds like there could be an opportunity to utilize those.
Indeed. Unallowed losses from a prior year, when an activity was passive but maybe it isn't passive anymore in the current year, can be deducted against current year income from that same activity under Section 469 F1A.
Okay.
For NIT purposes, these suspended losses are considered properly allocable deductions, but only to the extent that the net income or net gain from that activity or other passive activities is included in NIT in the current year.
So you can only use the loss against NIT income.
Generally, yes, against income from that activity or other passive activities that are subject to NIT. And if you sell your entire interest in such an activity to an unrelated person in a fully taxable transaction, then those suspended losses are allowed in full as a properly allocable deduction against NIA income in that year. It's about ensuring that those legitimate losses from previous years can eventually provide a tax benefit.
So understanding when those losses can finally be utilized is key for optimizing your tax position. What about economic grouping? How does grouping your activities impact the NIT?
You have the option to treat one or more trade or business activities or rental activities as a single activity if they form an appropriate economic unit. This grouping significantly influences whether an activity is considered passive for your tax purposes. Generally, regrouping activities is quite strict.
You can't just change it every year.
No, definitely not.
Yeah.
Typically only allowed if your initial grouping was clearly inappropriate or due to significantly changed circumstances. However, the NIT offers a unique fresh start election.
Ooh, a fresh start. What's that?
It's a powerful, one-time opportunity specifically for the first tax year you're subject to NIIT. Under this election, you can regroup your activities, and this new grouping then applies to that year and all future tax
So
years.
you get one chance to optimize.
Basically, yes, proper grouping can profoundly influence whether income from those activities is passive and thus subject to NIIT, making it a truly important strategic decision for taxpayers.
A fresh start election sounds like a hidden gem for optimizing your activities. Now let's tackle what can be perceived as truly complex. Controlled foreign corporations, or CFCs, and passive foreign investment companies, BFICs. What are these, in simple terms, and how do they factor into NIIT, especially with that Section 1.141110G election you mentioned earlier?
Right, these terms often make eyes glaze over, but they're crucial for international investors. A CFC is generally a foreign corporation where more than 50% of its voting power or stock value is owned by U.S. shareholders. A PFIC is a foreign corporation where at least 75% of its gross income is passive, or at least 50% of its assets produce passive income. Think foreign mutual funds sometimes.
Got it. And QEF.
A qualified electing fund, or QEF, is simply a PFIC for which the taxpayer has made a Section 1295B election, which allows for more favorable tax treatment generally.
Okay, so how does that Section 1.141110G election fit in?
Right. The Section 1.141110G election is designed to simplify how income from these complex foreign entities is treated for NIAT purposes. Its core purpose is to align the NIAT calculation for these specific investments with your regular income tax treatment.
So it tries to make things consistent.
Essentially, yes. If you make this election, you generally include certain inclusions from CFC or QEF stock in your net investment income, and you exclude distributions from that stock that have already been previously taxed for regular income tax purposes.
Avoiding double tax.
Exactly. That's incredibly important because without the election, these distributions might be included in NIT even if you've already paid regular income tax on the underlying earnings, potentially leading to a form of double taxation. The impact of this election is that it can streamline your tax calculations and prevent that potential hit.
Sounds like a good idea then.
It often is, but it's critical to remember that this election is irrevocable once made.
Irrevocable, wow.
And it applies to the specific stock you elect for and all later acquisitions of that same stock. There are also strict timing and content requirements for making this election, typically by checking a specific box on Form 8960 and attaching a detailed statement with all the necessary entity information. So careful consideration is definitely needed.
Irrevocable sounds serious, so clearly careful consideration is needed for that election for anyone with international holdings. Moving on, you mentioned a Section 1411 trade or business earlier. Can you clarify that definition? It seems like a specialized term.
Certainly. For NIT purposes, a Section 1411 trade or business is a specific classification. It's generally defined as a trade or business that is either a passive activity for the taxpayer, or R is a trade or business whose only activity is trading in financial instruments or commodities.
So passive businesses or trading businesses.
Right. This specific definition is important because income derived in the ordinary course of a non-Section 1411 trade or business, meaning an active business that isn't just trading, is typically the kind of active business income that is excluded from net investment income, offering that valuable NIT relief we've discussed.
Understood. And finally, before we roll up our sleeves and dive into the form line by line, what's the role of record keeping here? It sounds like it's more critical than ever, given the nuances we've already covered.
Record keeping is absolutely foundational, and I can't stress this enough. Because certain items of investment income and expense receive different treatment for NIT than for regular income tax, you must keep all records and worksheets for every single item you include on Form 8960. Everything. Crucially, you need to maintain records for the entire life of an investment, especially to accurately track and show your basis calculation for capital gains purposes. This is vital because you might need prior year information for carrybacks or carryforwards. Without thorough, organized records, navigating these complex rules and claiming the proper deductions becomes incredibly difficult, if not impossible, potentially leaving money on the table.
All right, that sets the stage perfectly. Let's roll up our sleeves and get into the practical application. We're moving into a detailed Form 8960 deep dive, specifically Part 1, which covers investment income and elections. This is where we really start to pinpoint those practical tax-saving opportunities that are baked right into the instructions. First, there are a couple of important checkboxes right at the top of Part 1. What are they and what do they signify?
Yes, these checkboxes are like initial filters for your NIIT calculation. The first one is for Section 6013G or 6013 election. This applies to U.S. citizens or residents who are filing jointly with a non-resident alien or NRA spouse. If you've already made this election for regular tax purposes, checking this box ensures that the joint election also applies for NIIT purposes, allowing you to use the higher $250,000 NIIT threshold for married filing jointly. If you don't check it for NIIT purposes, you'll be treated as married filing separately, which comes with that lower $125,000 threshold.
Got it. And the second checkbox is the Section 1.111110G election we just discussed for CSC and QEF owners, correct?
Precisely. If you are making or have already made that election for your CFC or QEF stock to align its NIIT treatment with regular income tax, you check this box. As we mentioned, it requires attaching a detailed statement with specific information about CFC or QEF, so make sure your records are ready.
Great. Now let's go line by line through the income section, focusing on those crucial adjustments and exclusions. Line 1 is taxable interest. What do we include here, and perhaps more importantly, what are the crucial adjustments that could reduce your NIT?
Okay, line 1. You'll generally include all taxable interest amounts from your Form 1040-1040-SR, Line 2B, or Form 1041, Line 1, and so on. This includes typical bank interest, bond interest, etc.
Standard stuff.
Standard stuff. However, for tax-saving purposes, there's a vital adjustment. If you have interest income that was earned in the ordinary course of your non-Section 1411 trade or business, meaning an active business that isn't primarily trading financial instruments, that interest is excluded from net investment income.
So how do you show that exclusion?
You would reflect this as a negative adjustment on line 7, which we'll get to later. Effectively, it removes it from the NIIT calculation. Also, if line 1 includes self-charged interest from non-passive partnerships or S corporations, there's a possible adjustment on line 7 to exclude it, preventing you from being taxed on interest you're essentially paying to yourself through an active business endeavor.
So if your interest income is genuinely tied to an active business, it's out. What about line 2, ordinary dividends? Similar exclusions there.
Similar principle, yes. Line 2 includes ordinary dividends from your 104010101 SR. Line 3B, or Form 1041, Line 2A. But again, for potential tax savings, there are important adjustments. Dividends from employer stock ownership plans or ESOPs that are deductible under Section 404K are excluded from NIT.
Okay.
Also, Alaska Permanent Fund dividends are specifically excluded. You would include these amounts as negative modifications on line 7, reducing your overall net investment income subject to the tax.
That's a good heads up for those with ESOPs or our listeners in Alaska. Line 3 is annuities. Are all annuities subject to NIT, or are there significant carve-outs here?
Not at all, and this is a crucial distinction. Line 3 generally includes gross income from annuities. However, there are significant exclusions that can save you from NIT. Annuities paid from qualified pension plans like Section 401 plans, qualified annuity plans like 403A or 403B annuities, IRAs, Roth IRAs, and 457B deferred compensation plans are not subject to NIT.
So your standard retirement income streams are mostly safe?
Generally, yes. Your typical retirement payouts are generally safe from this tax. Also, amounts paid in consideration for services like an annuity as part of an employment agreement are excluded. If you receive a Form 1099-RR, look for code D in box 7. That usually indicates amounts that are subject to NIT. If there's no code D and it's from a qualified retirement plan, it's generally good news for your NIT calculation.
So retirement plan distributions are generally safe from NIT. Good to know. Line 4A aggregates various income sources. Income from trades businesses, rental real estate, royalties, partnerships, S corporations, and trusts. This sounds like a broad starting point.
It is a broad inclusion. Line 4A essentially aggregates passive and non-passive income from various schedules, like Schedule 1, Form 1040, lines 3 and 5, or Form 1041, lines 3 and 5. This is the initial collection point for these types of income.
Okay.
The key, however, and where the real tax planning comes into play, is the very next line, 4B.
Line 4B. Adjustment for net income or loss derived in the ordinary course of a non-Section 1411 trade or business. This was flagged in our outline as a major tax-saving opportunity. How does this critical line work for our listeners?
You're absolutely right. This is perhaps the most critical line for active business owners to understand if they want to reduce or eliminate their NIIP liability. Its sole purpose is to remove from your NIT calculation income that isn't considered investment under the specific NIT rules.
So you subtract the income here.
You enter gains as negative adjustments and losses as positive adjustments. Effectively, this zeroes out the NIT impact for these non-investment income types, potentially putting money back in your pocket.
So what exactly do we adjust for here? What kind of income gets this highly beneficial exclusion? Can you give us some practical examples?
Yeah, a lot of key items fall under this umbrella. First, and this is the biggest one, net income or loss from a Section 162 trade or business that is not a passive activity for you and is not a business primarily focused on trading financial instruments.
So your active business profits.
Exactly. This is the core exclusion for active business income. Imagine you own a successful manufacturing plant, a consulting firm, or even a thriving local retail shop where you materially participate. The profits from that business are generally not subject to NIT because the IRS views that as your active labor and entrepreneurial effort, not just passive investment.
Okay, makes sense. What else?
Second, net income or loss from a Section 1411 trade or business that's already taken into account in determining self-employment income. This explicitly prevents that double taxation we mentioned. If you're already paying self-employment tax on your business profits, the NIT won't hit it again.
Good.
Third, royalties derived in the ordinary course of a Section 162 trade or business that is not a passive activity. This applies if you're, say, a professional inventor or author, and those royalties are part of your active business, not just a passive stream. Fourth, passive losses of a former passive activity allowed under Section 469. This is where those previously suspended losses from an activity that's now active can be put to work against NIT income. And importantly, various forms of non-passive rental income exclusions. This explicitly includes rental income from a real estate professional where the rental activity rises to a Section 162 trade or business, recalling our earlier discussion on that powerful safe harbor.
The 500-hour test, people.
Those folks, yes. If you meet those hour thresholds and professional criteria, your rental profits are exempt via this line. Also, net rental income or loss that is non-passive because it was properly grouped with a trade or business under the regulations. For example, if you rent an office building to your own actively managed business, that rental income can be recharacterized as active and adjusted out here.
Okay.
And finally, any net income that has been recharacterized as not from a passive activity under the Section 469 passive loss rules and is derived in the ordinary course of a Section 162 trade or business. This covers scenarios like a property you rent to a non-passive activity you materially participate in.
This is truly huge. For active business owners or dedicated real estate professionals, meticulously identifying and reporting these adjustments on line 4B could significantly reduce or even completely eliminate their NIT liability. It really underscores the profound difference the IRS makes between genuinely passive investment income and income derived from your active involvement in entrepreneurial effort.
Exactly right.
It's about leveraging your participation to your tax advantage.
It absolutely is. It's about recognizing that not all income that looks like investment income on a superficial level is treated as such for NIT. Your level of participation, the nature of the underlying activity, and whether it qualifies as a true trade or business are absolutely paramount. This is where proactive tax planning and proper classification really pay off.
Moving on to lines 5A through 5Bs, which cover gains and losses on dispositions of property. What's the general rule here for property sales, and what are the crucial exclusions that can save you from NIT?
Generally, any net gain from the disposition of property not used in a trade or business, and any net gain or loss from the disposition of property held in a Section 1411 trade or business, remember that's a passive business or a trading business, are included in net investment income, if they're also included in your regular taxable income.
So selling stocks, bonds, investment property.
Usually, yes. That applies to common scenarios like selling stocks, bonds, or non-business real estate. However, crucially, gains and losses that aren't taken into account in computing your regular taxable income are not included in NIT.
Such as? What are the common examples here?
The big common ones are the gain on the sale of your principal residence that's excluded under Section 121, up to $250,000 for single filers, $500,000 for joint filers.
That's huge for homeowners.
Massive. Or gains from like-kind exchanges under Section 131. These are explicitly excluded from NIT, which is another significant tax-saving consideration for homeowners and real estate investors conducting exchanges.
That's a huge relief for homeowners. Then there's line 5B, net gain or loss from disposition of property that isn't subject to net investment income tax. This sounds like another line for significant reductions. What exactly goes here to reduce that NIIT base?
Line 5B is specifically designed to adjust Line 5A by removing gains and losses that are excluded from the NIIP calculation. You enter gains as a negative number and losses as a positive number. Key items here include gain or loss from the sale of property held in a non-Section 1411 trade or business.
So selling active business assets.
Exactly. This is a major exclusion. If you sell an asset that was genuinely used in your active business, that gain is generally not subject to NIIT. Think of selling equipment from your manufacturing plant or an office building from your consulting firm that you actively use.
Okay.
Also, gain attributable to net unrealized appreciation, or NUA, in employer securities held by a qualified plan. This is a subtle but important one. The gain from NUA realized when you dispose of employer securities from a qualified retirement plan is treated as a distribution and is excluded from net investment income.
So the growth inside the plan is safe.
The NUA part, yes. That initial appreciation that built up while in the plan isn't hit. However, any subsequent appreciation after you receive the distribution is included if you sell later.
Got it. Anything else for 5B?
For shareholders of qualified electing funds, QEFs, without a Section 1.141110G election in effect, amounts treated as long-term capital gain for regular income tax under Section 1293A1B are specifically excluded from NIT, and there are adjustments to your capital loss carry-forwards for items of excluded loss, which is crucial for managing your future tax liability related to NIIT.
That NUA exclusion is particularly interesting for those receiving large payouts from ESOPs. That initial appreciation isn't hit by NIT, though future growth might be. What about line 5C, adjustment from disposition of partnership interest or S corporation stock? This seems particularly complex, but incredibly important for business owners selling their stake.
This is indeed complex, but absolutely vital for business owners who sell their interests. The general rule is that the sale of a partnership interest, or S corporation stock, is generally included in net investment income.
Oh, why is that?
Because it's typically not considered property held for direct use in a trade or business from the seller's perspective. You're selling the stock or interest, not the underlying business assets directly. However, there's a significant exception, and this is where the adjustment on line 5C comes in.
Okay, the exception. How does this apply to reduce the NIIT? Can you walk us through a common scenario?
Sure. If you materially participated in a trade or business activity of that partnership or S corporation, and it wasn't a business of primarily trading financial instruments or commodities, then you must calculate a specific adjustment. This adjustment will reduce the gain or increase the loss reported on line 5C.
So it carves out the active part of the gain.
That's a good way to think about it. It effectively excludes a portion of that gain or loss from the sale from your NIT liability. For example, imagine you are a longtime partner in a successful consulting firm, and you were deeply involved in its day-to-day operations you materially participated. If you sell your partnership interest, a significant portion of your gain, representing your active sweat equity, might be excluded from NIT thanks to this adjustment.
But you need proof.
Absolutely. This requires attaching detailed statements to your return for the year of disposition, outlining the entity's name, taxpayer identification number, the gain or loss, and any basis adjustments for CFCs or QEFs if applicable. For deferred recognition sales, like installment sales or private annuities, these adjustments are calculated in the year of disposition, even if payments are received later, and the difference is then recognized proportionally with each payment. This is a nuanced area where proper documentation and meticulous calculation can lead to substantial tax savings for business owners exiting their ventures.
It's clear that detailed record keeping, as you hammered home earlier, is absolutely paramount for these complex transactions. Now let's move into some of the even more specific adjustments and critical deductions, where we can find more powerful opportunities to reduce that taxable base. Line 6 is adjustments to investment income for certain CFCs and PFICs. Who does this apply to, and what kind of adjustments are we talking about here?
Right. Line 6 is primarily for international investors who own stock directly or indirectly in those controlled foreign corporations, CFCs, or passive foreign investment companies, PFICs, particularly those not held within a Section 1411 trade or business. The purpose here is to make specific increases or decreases to net investment income that aren't already reflected elsewhere on Form 8960. This is largely due to the complex anti-deferral rules designed for foreign investments.
Can you give us some examples of these adjustments, perhaps simplifying the technical jargon a bit?
Certainly. Let's see. If you're invested in what the IRS calls Section 1296 mark-to-market PFICs, This line is where you'd include certain income amounts and deduct certain loss amounts related to those investments. For Section 1291 funds, you'll include what are called excess distributions and any gains treated similarly.
Okay.
If you have that crucial Section 1.141110G election in effect for a CFC or QEF, this is where you'd include certain earnings that are typically taxed on a current basis under regular income tax rules. Conversely, if you don't have that election, you might need to include certain distributions of previously taxed income that weren't subject to regular income tax or make alternative basis calculations for NIIT purposes. All these aim to ensure that the proper amount of foreign investment income is captured or correctly excluded for NIIT purposes based on very specific, complex international tax rules.
So it's about making sure NIT aligns with those intricate anti-deferral rules for foreign stuff. Got it. Let's move to line 7, other modifications to investment income. This sounds like the ultimate catch-all for various adjustments, both positive and negative. What are the big ones we should be aware of here, especially for tax planning?
Line 7 is indeed a crucial catch-all line for additional modifications that aren't specifically called out on lines 1 through 6. One of the most significant tax planning tools you'll find here is the Section 1411 Net Operating Loss, or NOL.
And an NOL can be a powerful tool for regular income tax. How does it apply to NOT, and how can it specifically help reduce that investment income tax?
It's a significant point because it offers direct tax savings. You may be allowed to deduct a portion of your regular NOL against your net investment income for NIT purposes. The calculation is specific. Your Section 1411 NOL for a loss year is the lesser of your NIT-specific NOL, meaning only your investment income and properly allocable deductions are considered, or your regular income tax NOL.
Oh, the lesser of the two.
Right. The applicable portion of NOL, which is the percentage of the regular NOL, that's a Section 1411 NOL, can directly reduce your current year NIT.
Could you walk us through a quick example to illustrate how this works practically for a listener, especially showing how it carries over and provides benefits?
Absolutely. Let's imagine an unmarried individual. Say they had a total regular income tax NOL of $150,000 from 2019, but for NIT purposes, none of that was considered a Section 1411 NOL.
So zero applicable portion.
Zero applicable portion for 2019. Then, from 2020, they have a $100,000 regular NOL, and $30,000 of that was a Section 1411 NOL, giving it a 30% applicable portion. A $40,000 NOL from 2021 was 100% Section 1411 NOL, and a $120,000 NOL from 2022 had $60,000 as Section 1411 NOL, so a 50% applicable portion.
It's okay following so far. Now, when they use these NOLs in, say, 2023, the $150,000 from 2019 reduces their regular income, but none of it reduces NIT because its applicable portion was zero. If they use the $100,000 from 2020 against regular income, then $30,000 of that, 30% of 100K, specifically reduces their NIT. The entire $40,000 from 2021 reduces NIT. And if they use, say, $10,000 from the 2022 NOL against regular income, then $5,000 of that, $10,000, 50%, reduces NIT. So in 2023, they might have a total Section 1411 NOL deduction of $75,000, $0 plus 30K plus 40K plus 4K, significantly cutting their NIT for that year.
Wow, that's complex tracking, but a big potential benefit.
Exactly. And crucially, if in 2023 their regular income tax NOLs caused their AGI to fall below the NIT threshold, they wouldn't be subject to NIT anyway for that year. But the calculation still prepares them for future years. Then, if in 2024 they still have $110,000 remaining of that 2022 NOL, which was 50% Section 1411 NOL, they can deduct $55,000, $110,000, 50% against their 2024 net investment income.
Okay, so the benefit carries forward based on that applicable portion. Precisely. This demonstrates how carefully tracking and applying your Section 1411 NOL can significantly reduce your NIT liability in future years. A crucial rule here is that no portion of an NOL incurred in a tax year beginning before 2013 is permitted to reduce net investment income. So it's forward-looking from 2013 on.
That's a critical limitation.
Yeah.
What other significant adjustments fall under Line 7? This line truly seems like a Swiss Army knife for various situations.
It really is. Line 7 also includes other Section 62A1 deductions, which are generally above-the-line deductions from Schedule 1 if they are properly allocable to a Section 1411 trade or business and not already on Lines 4 to 6. An example is an early withdrawal penalty for a CD, which is treated as an investment expense for NIIT purposes. You'll also see adjustments for distributions from estates and trusts specifically, amounts from Schedule K1, Form 1041, Box 14, Code H, which can impact both your NIIT and MAGI by reducing the estate's or trust's undistributed net investment income. Section 404(k) dividends, which we mentioned earlier, are explicitly a negative adjustment here. And self-charged interest income from certain non-passive activities, where the corresponding interest deduction isn't subject to self-employment tax, can also be excluded as a negative adjustment.
You also mentioned deduction recoveries. This sounds a bit complex, but essential for prior year planning. Can you explain that, especially the crucial exceptions for avoiding NIAT on these recoveries?
Deduction recoveries are indeed nuanced, but understanding them can prevent unexpected NIT. Generally, a recovery or refund of a previously deducted item increases your net investment income in the year of recovery. This applies even if the original deduction didn't provide a tax benefit for regular income tax due to rules like Section 111.
So even if it didn't help before, the recovery hurts now.
For NIT, potentially yes. However, and these are your key exceptions for avoiding NIT on recoveries. First, if the original deduction was from a tax year before 2013, none of the recovery is included in net investment income. That's a clear cutoff.
Okay, pre-2013 is safe.
Second, if the original deduction was in a year after 2012, but you weren't subject to NIT solely because your NGI was below the threshold in that original deduction year, then generally none of the recovery is included. The exception to that exception is if you did have a Section 1411 NOL that year, that would have absorbed the deduction. It gets tricky. Third, if the recovered amount relates to an item that would have been included in net investment income in the year of recovery, meaning it's already accounted for on lines 1 through 6 of Form 8A960, then it's not included on line 7 as a separate recovery.
So it essentially applies the tax benefit rule, specifically within the NIAT framework, independently from the regular income tax. That's a subtle but important point for managing those recoveries.
Yep.
Any other noteworthy items that might appear on line 7?
Yes. Line 7 also captures amounts from Form 8814 Parents' Election to report child's interest and dividends, excluding Alaska Permanent Fund dividends. It can also include substitute interest and dividend payments, net positive periodic payments from notional principal contracts, reference to investment-producing property, and gains or losses from the disposition of annuities or life insurance contracts. And importantly, casualty and theft losses, if properly allocable to investment property, can be entered as negative adjustments, further reducing your net investment income.
That brings us beautifully to Part 2 of Form 8960, Investment Expenses Allocable to Investment Income and Modifications. This section is all about identifying and claiming deductions that reduce your taxable base for NIT. What's the general principle here for claiming these deductions?
The general principle is that deductions must be properly allocable to your net investment income. This is a critical concept. For expenses that are allocable to both net investment income, which is subject to NIT, and excluded income, which isn't, you are allowed to use any reasonable method to determine the portion allocable to NIT.
Any reasonable method. That sounds flexible.
It offers valuable flexibility for taxpayers to maximize their deductions, yes.
What are some examples of these deductions that can be allocated, and what might a reasonable method look like in practice?
Examples of deductions for allocation include state, local, and foreign income taxes paid on investment income, expenses incurred to determine, collect, or obtain a refund of any tax owed related to investments, and administration expenses for estates and trusts, such as fiduciary fees.
Okay.
A common and generally reasonable method of allocation for individuals, for example, is to use a ratio of your gross investment income, from Form 8960, line 8, to your adjusted gross income, AGI. For estates and trusts, allocations made under certain regulations are considered reasonable. It's important to note that if a deduction isn't specifically identified in Section 1411 regulations or IRS guidance, it's generally not permitted for NIT purposes, so clarity and documentation are key.
So clarity and a robust paper trail are key, as always. Let's look at line 9A, investment interest expense.
Okay. Line 9A is where you enter your investment interest expense. For individuals, this typically comes from Schedule A, line 9, and for estates and trusts, from Form 4952, line 8. A caution here. Be careful not to double count amounts that may already be reflected on line 4A from Schedule E, for example, if they're related to a passive activity trade or business whose income is already captured there.
Right.
Also, if you own a CFC or QEF without a Section 1.141110G election, your investment expense deduction may be calculated differently for NIT purposes, requiring adjustments on line 6.
Line 9B is state, local, and foreign income tax. This is a big one for many taxpayers.
Yeah.
What's the critical context here for tax savings, especially given recent tax law changes?
This is indeed very important, and it represents a significant tax-saving opportunity for a limited time. You can only include state, local, and foreign income taxes that are directly attributable to your net investment income. You cannot, however, deduct foreign income taxes if you took a foreign tax credit for them. But the critical tax-saving implication for tax years 2018 through 2025 is that miscellaneous itemized deductions under Section 67 and the overall limitation on itemized deductions under Section 68 are suspended.
Suspended. That's a powerful word in tax terms. What exactly does that mean for our listener and their potential tax savings?
It means that for these specific tax years, 2018 through 2025, if you have properly allocable state, local, or foreign income taxes related to your investments or miscellaneous investment expenses, you can take them without being subjected to the 2% of adjusted gross income floor or the overall limitation on itemized deductions that typically apply.
So no phase-outs or floors for these deductions against NIT.
For these years, no. This is a significant advantage, effectively allowing you to fully deduct these expenses against your net investment income, thereby reducing your NIT liability much more effectively than in periods when these limitations were in effect. The detailed worksheets and the instructions for lines 9 and 10, which usually deal with these limitations, are explicitly not used for these years, making the calculation simpler and the deduction more potent.
That's a huge piece of news for current tax planning, a green light from the IRS for these deductions against NIT. Line 9C covers miscellaneous investment expenses. Is it similar to 9B regarding these suspensions?
Yes, exactly. Line 9C is for expenses directly connected to the production of investment income, generally those from Form 4952, Line 5. And again, for tax years 2018 through 2025, these amounts are also not subject to the Section 67 or Section 68 limitations due to their suspension.
Like investment advisor fees.
Potentially, yes. This means a fuller deduction for expenses like investment advisory fees, legal fees for investment-related matters, or safe deposit box rental fees if they're properly allocable. Just be careful not to double account expenses already deducted elsewhere, like depletion or depreciation reported on Schedule E and already included on Line 4A.
So for the next couple of years, if an expense is truly and properly allocable to your investment income, you're getting the full benefit of that deduction against NIT. That's a very significant, albeit temporary, tax-saving opportunity. Finally, line 10, additional modifications. What else can we deduct here, and is there a specific, targeted tax-saving tip for a particular group of taxpayers?
Line 10 is the final catch-all for other properly allocable deductions, not specifically listed on lines 1 through 9. And yes, there is a very specific and potentially large deduction here for traders in financial instruments or commodities.
A targeted tax-saving tip for traders. Tell us more. This could be a game changer for them.
If your only business activity is trading in financial instruments or commodities, meaning you qualify as a trader for tax purposes and not just an investor, you can deduct your Schedule C expenses directly on line 10 of Form 8960.
Directly against investment income?
Directly against net investment income here,
Sure.
yes. Crucially, you generally don't even need to complete Schedule SE for self-employment tax for this income if trading is your only business. This is a huge benefit. If you have multiple businesses, it's a bit more involved. You'll need to use a specific worksheet provided in the instructions to determine how much of your Schedule C expense can be deducted on line 10.
Wow.
This is a critical distinction for traders, as these expenses, if properly accounted for, can substantially reduce their net investment income subject to NIT. And just like with lines 9B and 9C, the suspension of Section 67 and 68 limitations for 2018-2025 also applies to deductions entered on line 10, maximizing their impact.
That's a very specific but potentially very large deduction for the right kind of business. Now we've covered the income and deduction pieces. Let's bring it all together in part 3, tax computation. This is where the rubber meets the road for calculating the final NIT. Starting with individuals, line 13 is modified adjusted gross income, MAGI. You mentioned this earlier as the gateway. Can you briefly reiterate how it's calculated and why those adjustments are so important here?
Absolutely. For most individuals, if you didn't exclude foreign earned income under Section 911 and don't own CFCs or PFICs, your MAGI on line 13 is simply your AGI from Form 1040 or 1040 SRR. However, if you do exclude Section 911 income, you must increase your AGI by the excluded amount, net of any disallowed deductions.
Right.
If you own certain CFCs or PFICs, you'll need to make specific adjustments. Generally, increasing AGI for Section 1291 excess distributions or certain distributions from CFCSQFs without a Section 1.141110G election, and potentially decreasing AGI for Section 951-951A-1293A inclusions if no election is made. These adjustments are vital because they determine if your income level crosses the NIT threshold in the first place.
And line 14, threshold based on filing status. Just a quick recap of those critical dollar thresholds as they're the ultimate determinant of NIIT applicability.
Yes, these are the key numbers. For married filing jointly or a qualifying surviving spouse, it's $250,000. For married filing separately, it's $125,000. And for single or head of household, it's $200,000.
Got it.
It's important to remember that a bankruptcy estate of an individual always uses the $125,000 threshold, regardless of the debtor's marital status. Also, if you're a U.S. citizen or resident married to an NRA, your filing status defaults to married filing separately for NIIT purposes, unless you specifically made and elected to apply a Section 6013G or 6013H joint election for NIT purposes, which would allow the higher $250,000 threshold.
Okay. Then line 17 gives us the net investment income tax for individuals, which gets transferred to Schedule 2, Form 1040, line 12. So what about for estates and trusts? How do they navigate Part 3 as their tax structure is often quite different?
Estates and trusts indeed have their own specific rules for calculating NIT. Line 18B is particularly important for them. Deductions for distributions of net investment income and charitable deductions. This line significantly reduces the undistributed net investment income of an estate or trust, thereby lowering its potential NIT.
How does that mechanism work for estates and trusts? It sounds like they get a deduction for paying income out.
That's essentially it. The undistributed net investment income, which is ultimately calculated on line 18C, is reduced by the net investment income that's included in distributions made to beneficiaries. These distributions are deductible for the estate or trust under Sections 651 or 660.
Okay.
It's also reduced by net investment income for which the estate or trust was entitled to a charitable deduction under Section 642C. For electing small business trusts, or ESBTs, it's reduced by charitable deductions under Section 170. This uses a class system of income categorization to determine how much of the distribution to a beneficiary is considered NIIT-related income. The instructions suggest using Form 141, Schedule A and B, as helpful worksheets to accurately calculate these amounts.
And line 18C, undistributed net investment income, can't be a negative number, so it's zero if negative. What about their adjusted gross income on line 19A compared to individuals?
For estates and trusts, line 19A is typically their regular AGI. But similar to individuals, if they own CFCs or PFICs, they may need to make the same types of specific adjustments to their AGI as discussed for individuals to arrive at the correct NGI for NII2 purposes.
Then on line 19B, it's the highest tax bracket for estates and trusts. Why is that the threshold for them rather than a fixed dollar amount like for individuals?
That's a good question. For estates and trusts, the applicable threshold amount for NIIT purposes is the dollar amount where the highest tax bracket in Section 1E begins for the tax year.
So it changes each year with inflation.
Exactly. This simplifies the threshold compared to individuals' varied filing statuses and makes it automatically adjust each year. There are also special computational rules for qualified funeral trusts, or QFTs. For example, if a QFT has multiple beneficiary contracts that individually exceed the threshold, you multiply the number of such contracts by the threshold amount for line 19B, effectively applying the threshold per beneficiary interest.
And for electing small business trusts, ESPTs, it's a three-step computational process for NIT. That sounds quite involved.
Yes. ESBTs calculate their NIIT using a specific three-step process that accounts for their unique S and non-S portions. First, they separately calculate the undistributed net investment income for both their S portion and non-S portion, and then combine them.
Okay, two pieces.
Second, they determine their adjusted gross income, AGI, solely for NIIT purposes by adding the net income or loss from the S portion to the AGI of the non-S portion.
Combining AGI too.
And finally, they compare that combined undistributed net investment income with the excess of their calculated AGI over the Section 1E highest tax bracket threshold to determine if and how much NIIT they owe. It's definitely a more intricate calculation to ensure proper NIIT application given their hybrid structure.
That's quite a bit of complexity for ESPTs, highlighting the need for careful review of the instructions. Finally, line 21 is the net investment income tax for estates and trusts, which gets transferred to Form 1041 Schedule G, line 5, or Form 1041 QFT, line 15.
That's the final number for them.
Okay, here's where it gets really interesting. We've just navigated one of the most complex yet potentially impactful forms for your investment income. Understanding these nuances isn't just about simple compliance. It's about making highly informed financial decisions that can genuinely impact your bottom line.
Absolutely.
We've seen how specific details like the nature of your business activity, your level of material participation, or even the timing of certain elections can strategically shift income out of the NIIT's grasp.
Hmm.
The powerful exclusions for active trade or business income, that real estate professional safe harbor, the careful handling of disposition gains from partnership interests or S corporation stock, the strategic use of Section 1411 NOLs, and the proper allocation of investment expenses, especially with the temporary yet significant suspension of those Sections 67 and 68 limitations. These are all tangible avenues for tax savings that are clearly outlined in the instructions themselves.
This raises an important question. Given the intricate nature of the NIIT, especially with various selections, activity groupings, and the very specific rules for complex assets like CFCs or PFICs, how might understanding these specific instructions fundamentally shift your approach to future investment strategies?
Yeah, good question.
Think about how these rules could influence your asset allocation, your level of active participation in businesses, or even your decision to structure certain passive income streams. These regulations can truly incentivize or disincentivize particular financial behaviors for individuals and trusts aiming to optimize their tax position.
So what does this all mean for you, the listener? We covered a lot today, from the fundamental definitions to the nitty-gritty of various deductions and adjustments that can truly impact your tax bill. What stood out to you? We always love hearing about your aha moments. Perhaps you'll re-listen to this deep dive, now armed with the knowledge to focus on the specific details most relevant to your situation, understanding that these tax forms aren't just about obligations, but are packed with opportunities for strategic financial management and real tax savings. This deep dive truly empowers you to be a more informed, more confident taxpayer.